Here we go, my friends. Welcome back to Data Day. Today, the numbers are in. Now, what happened in January? Is it a record month? Is it not a record month? Is it going up or down? That's the question we'll answer right here on the Logistics Live. Hey there, everybody. Welcome back. Dean, what a month in January.
Yeah, we thought it was going to happen. I didn't think it'd be this much. Like, this is kind of nuts, Dan, to see this much import volume in January. So remember, right now we're in the middle of Chinese New Year, the Lunar New Year, to be more precise. So it's a pretty big deal in Asia because when you look at the data, Northeast Asia, which is mostly China, accounts for 60% of our import volume, certainly last month.
So what happens? It was upwards around 80%.
Well, it depends on the port. It depends on the port.
Okay. Yeah.
So the numbers kind of pan out. Northeast Asia, 58%, Southeast Asia, 15%, North Europe, 6%. So they're your regions, right? When you go down to the country level, it gets a little bit more specific. Furniture, again, remains the top import. But I'll go back to my Lunar New Year point. Normally what happens, because of the infrastructure development in China and how they built millions of kilometers of roads, it's opened up the entire economy. And of course what that means is most families live in rural China. So when Chinese New Year happens, people that work in factories go home to celebrate Lunar New Year. And what typically happens is, for the 1 week celebration, a week either side is allowed for travel to home and back to the factories. So it's a 3 week period where factories shut down. So if Northeast Asia represents almost 60% of import volume and it shuts down for 3 weeks, typically January, February period, you always see this massive drop off in inventories. Now, inventory coming into the US. So February, March, when you look at the line graphs, are typically the real low points in import volume. And then from April onwards, they start to pick up through to peak shipping season in October. There's sort of a gradual line. The pandemic was a little bit different because it kind of altered all of that seasonality. Factories didn't go home to their families in Lunar New Year. They stayed open and kept working for the demand. So when you look back at your line graphs and compare your year-over-year comps, it's a little bit difficult. You've got to normalize it for what happened during the pandemic. This is different. This isn't pandemic related. We have now just witnessed, I think, September, October, probably 5 months of record container imports from Northeast and Southeast Asia by shippers looking to get ahead of any tariff that the new administration might put on imports. And I think that's happened. So what we've just seen is a record volume of containers in January at I'll just get the number here, Dan, 2.635 million. So the month of January, it's up 13% year over year. It's up 6% month over month. Dan, normally if I took a line normally it's about 2.1 million. So we've imported about 500,000 more containers in January than we would typically in a normal January where things quieten down, factories close in China. It's the quiet season for us in the shipping front. So where's all this freight going? And of course, we've been reading about lots of warehouses have got lots of space. So there's been an excess of warehouses that were built. So we're filling up our warehouses again. We've got, I suspect we'll be talking about bloated inventories in 3 months. There's my crystal ball prediction, right?
We'll be talking about a bunch of things on sale, a bunch of people trying to get rid of items from the winter that they're now stocking up their warehouse when they need it for summer items and spring items.
So this is kind of extraordinary. Just to put this into perspective, the record number of containers imported into the US was 2.7 million, just under 2.7 million in May of 2022. Now remember, that was just after Russia invaded the Ukraine and we started to witness a big drop off in demand and freight rates started to head south for the best part of 27 months from that point on. So it was a really interesting
And that
inflection
that
point.
was still during the pandemic, wasn't it?
Correct.
2022 was okay. And
Yep.
so 2022, I mean, I know it was rampant in 2021, but 2022, was there still boats off the ports
We
waiting?
just started to clear them. So I think it was January of 2022, we had the record number of container ships. We had 109 vessels parked, sitting around waiting to unload. Now, a little bit before this record, they changed the strategy. They didn't allow all the vessels to come into Los Angeles and just drop anchor. They asked them to slow steam coming out of Northeast Asia. So rather than bunching around Los Angeles, they got them all to slow down and sequence them into the port that way. So it
Got it.
didn't
Okay.
appear like you had a congestion problem. You just had vessels slow steaming all the way across the Trans-Pacific. So Dan, just to recap, if that was the record from the pandemic at 2.7 million, this is a month of 2.635 million. So call it 60,000, give or take, containers
I mean,
fewer.
that's really, Dean, what, 3 ships, 4 ships?
Yeah, the big
More?
ones. Yeah, the big
Yeah.
mega vessel. Yeah. So, but it's a lot of freight. It's a lot of freight coming
Yeah.
into Los Angeles. Los Angeles volumes are up 12% year over year. Long Beach, which is the smaller port, different commodity mix, it's up 34% year over year. 14% of Long Beach is furniture. I mean, furniture is the big thing, menswear, footwear. I'll show you some numbers. When you just look at the change, the year over year, like what are we bringing in? So what's in these containers? When you look at furniture, it's up 15% year over year. Plastic products up 18% year over year. Menswear up 16%. Auto parts up 2%. Footwear up 18%. Bags up 19%. So it's all the sort of consumable things that are made overseas that are kind of labor intensive. So you say, why are we bringing all this stuff in? Why don't we make them here in the US? Well, these are very labor intensive commodities, and we've outsourced to low cost labor countries.
Mm-hmm.
Footwear is another one. Like we talked about footwear in the show last week. Footwear is very labor intensive. A lot of our imports come from other countries where labor is cheaper. That's the reality. But I think why I wanted to talk about this is that tariffs are here. There's already a tariff put on China. We're now seeing reciprocal tariffs. What does this mean for us in supply chain and logistics? It goes back to where you and I talked about it during the pandemic. You had friends that were storing freight in anything that had 4 walls and a roof. We could see a similar situation. I don't think we'll see it that bad, but what we're going to see is bloated inventories. And I think what that does to the freight market. So again, put this into context. It generates about 10% of truckload demand on the import side, but then a lot of those products that come in are used as inputs into other things that we make and put on the back of our trucks and trains. If you're bringing in record volumes in the month of January, which is normally a quiet month, where are you robbing the volume from down the road?
Mm-hmm.
Right, so we already know
Not
Q1.
only robbing the volume. I mean, so I have one customer in particular. They're one of their warehouses at 192% capacity. Like literally, they're looking to put things outside, and they're renting this facility. So the owner's like, no, this isn't like a Sam's Club outside, you know.
Right.
And my question became, okay, so I mean, I understand why they pulled forward. All 100% of their product comes from Asia, right?
Yep.
So I get it. But my question became, what's cheaper?
Right.
The additional, I think it was 10% that the US government put on, or Trump put on Asia.
On top of the 2018 10%.
On top, yeah. So I'm just talking like right now, the pull forward, right?
Yeah.
Or warehousing 2,500 pallets.
Right. What's cheaper? Well,
What's
so
cheaper?
I think, because you've got an excess of warehouse inventory, so there's better deals to be cut there. We've been reporting that people that own big warehouses have been cutting all sorts of amazing deals just to get, some leased square footage in play. So I think the economics must work out, Dan. Remember, on the intermodal side, Ari Asher's Journal of Commerce intermodal index came out last week. Shippers that are moving freight, this sort of freight on intermodal, save about 26% versus truckload. So like if you're getting imports in and you've got a warehouse that you can fill and you're getting almost it's a quarter less to run a train with your product than a truck, I think the economics must be making sense. Because remember during the pandemic, what was worse for companies? To have higher storage costs or not have the product at all to sell during peak season. And
I get that, but I guess where my question is, Dean, I'm very sorry for interrupting you, but my question is, and this was the question I asked my customer, and he kind of sat back and didn't answer me. But during the pandemic, it was one of these things where, and again, my understanding was I'm going to call it Asia-bound market was decimated.
Right.
So to get containers back to Asia was the bigger issue than anything. And now we don't have that problem. Right. I mean, I'm sure this will eventually come down the pipe, or eventually companies will see it and there'll be some data on this. But I would be really curious to see, there doesn't seem to be a production problem in Asia. There's not a ship problem with, I don't hear much about containers being bumped or not making sales, or the only time I hear about it is when like an Amazon has something going on where they just bump everybody kind of thing, right? A Home Depot, that kind of thing. So that flow, I mean, we have the Chinese New Year, 3 weeks, and maybe it was a fact that didn't know what was going to happen in those 3 weeks. It makes a difference, the 10% versus 25%, and I get all of that. But even if you say buy $1 million worth of product, right? So it's 1.25 million, right? So you have $250,000 worth of product, and say that I guess the economics does work out if you're.
They have to, Dan. It has to work out. Otherwise, they wouldn't be doing it. I don't understand the economics either, but I do know that the economics of shipping, low-cost commodities via intermodal from the West Coast to the East Coast works out because you're saving so much. Now, don't forget, a train is also a mobile warehouse at a much slower speed. So the average road speed, one of the intermodal trains is 23, 24 miles an hour. So when you think about if you're going to, if you've got 53-foot boxes and there's ample of those laying around, we know that the big intermodal carriers brought lots of 53s, and we've seen them stacked up all around the country. So they're a very low-cost item to run empty across to the West Coast and fill it and let it sit for 3 or 4 weeks, before it gets delivered. So you could see. Because remember in trucking, though, we always sort of complain about the truck is the mobile warehouse, and it's kind of an extra bit of square footage in terms of capacity. If you move enough freight, it adds up. You've always got freight sitting in trucks. It's mobile capacity, and drop trailer pools also become additional capacity also. So I think all of this is part of it. But I think sort of widening our lens a little bit here. I think this on top of tariffs and any particular impact on manufacturing. Absent a massive change in corporate tax rates or personal income tax, which is also, the wild card here. This is what we're doing with tariff revenue. We're all going to pay for the tariffs, right? Because they're going to be passed on to you and I. But then, do they get offset by massive tax cuts to win us back? So I think there's a long-term play here. But what happens though, Dan, is demand destruction in the interim. And for truckload carriers that voted for this is really problematic because it means you've got less demand and higher costs at a time when we're just coming out of the pandemic freight recession. We're still clawing our way off the bottom here. And the last thing we need is any uncertainty. And
I feel like we were climbing this mountain and we just got to the tip and got our fingers on the tip, and then somebody came and just kicked us in the face.
Well, if you look at
tumbling back down again.
If you look at contract rates, right? So the RFPs that large carriers have been negotiating with their shippers, the latest data shows about half rates are going up, half are going down. So there's kind of winners and losers on different lanes, but we're not at a point where when a carrier goes to a shipper that rates are automatically going up across the board. That's not happening yet. But remember, 3 months ago, they were still coming down across the board. So we're still at the bottom of this freight cycle, this inflection point. And of course, it's happening at the worst time, which is a slow quarter, typically in the freight season anyway. And then on top of that, we've got this pull forward, which is, we're taking inventory and volume from April, probably, I'm going to say March, April, and we've had it in the warehouses 4 or 5 months earlier. So what you'll see is a very muted peak season again, which again is a familiar story.
Mm-hmm.
So instead of banking on Q3 being a real revenue earner, a lot of that's going to be short haul final mile moves to, from a warehouse to a delivery point, like another, maybe a 3PL cross loading, cross dock, or a final delivery to a customer. So a lot of that long haul upstream freight will have already moved. I think that has an impact. Private fleets are still moving a lot of their own freight on their own trucks. Jason Miller reported that this week. It's secondary, though. It's a secondary problem for low truckload volumes. But, we've still got a very sluggish manufacturing sector. There's nothing there that's sort of saying that we've got anything that's going to be, moving the needle. I'm just trying to find the US Bank shipments index came out. Q4 shipments were down 16%. So US Bank shipments index, so they're the freight payment side of US Bank. Shipments in Q4 were down 16% year over year compared to Q4 2023. So now normally, Dan, remember on our show a few weeks ago, we talked about 3 of the leading indicators were down in December, which was a surprise during what's normal peak season. And I kind of said, this is a little bit worrying when you see 3 of your leading indicators fall in December as opposed to going up. US Bank's just the 4th now that says that volumes, Q4 was actually a really tough month for carriers in particular. I'm not sure how broker margins fared, but I do know that we saw an exodus of carriers out of the market in the spot market in December, which was a little bit uncharacteristic. And because normally that happens in January when the new year comes around, because carriers hang in there to make the most of Q4 and better rates. Well, that didn't happen to a degree that, made a difference, I think, to a lot of those marginal carriers. So it looks like Q4 was a pretty average one. And now on top of that, we've got this pull forward of inventories. We've got all this uncertainty. And now this week, we've got tariffs on anybody that's, remotely closely tied to trade. I just think it creates so much uncertainty because, Dan, you started the show by talking about it. People have just got to wait and see. Like, who knows? I don't have any answers about where this goes. I just don't see any upside to it. Because tell me about how angry Canadians are about what's happened. Like, tell me the damage has not been done there on a trade basis.
The damage has been done. I mean, I think when if we talk politics for a second, in the end, Dean, politics is politics. I often think of it where, it's like this. It's called Rap Superstar by Cypress Hill.
And, here we go.
Yeah, here we go. Yeah, and so at the beginning, it's Eminem talking about, the fact that whatever happens, you got to kind of put a smile on and you got to, pretend like nothing's happening.
Yeah.
And I think this is what politics is going to be for us for a very long time. I mean, Doug Ford's like, not a chance. You try and impose tariffs on us, we're going to put a tariff on your stuff. And every country's pretty much coming back and saying, okay, you want to do that to us, we're going to do that to you.
Right.
I was at my dealership 2 weeks ago, and he was saying, like, everybody is like, I have no idea what to do. I have no, and how much of it is rhetoric and how much of it is actually going to come true. I don't know, but I'll tell you, I mean, a lot of our politicians up in Ottawa and stuff, and even the leaders of each province, besides Alberta, I think Alberta is the only one that's like, yeah, definitely, man. But it's like all our milk that we ship to the U, like,
Dan, Canadians, you guys, I mean, Canadians, I think you're a lot like Australians in a way. Like, we get pretty offended if you do something like this because it's about trust.
Yes.
Like, Canada's been a wonderful trading partner. So has, people here in Australia, people in Germany. Like, a lot of people have built trade on trust, being a good negotiating partner. When you do something like this, it kind of undermines it. And I'm struck by the people out in Nova Scotia and the Maritimes saying, you know what, we're just going to pull all US liquor off our shelves.
Yeah, I mean, that's everywhere, even Ontario.
It's not going back.
And it's interesting because I'm talking to a bunch of Canadian companies, and one of the big conversations we had over the last couple of weeks was how can we get more competitive to Western Canada?
Right.
And the question was, well, why? And they said, well, we're reliant a lot on the US.
Right.
But what we do and the value we bring to our customers in the US, the honor integrity that we have with our customers, above our customers is being dictated onto what it's going to cost.
Right. Right.
And so they're looking at a Canadian market to say, well, how do we get better in Canada so companies in Canada order from us as opposed to order locally?
Yeah.
So we got 3 or 4 projects on the go with that.
I was just looking at LoadLink's spot market data. We saw a massive surge in volumes, cross-border volumes, in the fourth quarter. It was some of the highest cross-border volumes since March of 2023, so almost in 18 months. So capacity tightened, demand, freight volumes were up 14% in December compared to November. So what that tells me is you're about to see a big fall off in cross-border volumes. So your cross-border carriers, so what that could mean though, if you're in the capacity space or, acquiring space, when volumes fall like that, and because it's such a specialized part of the market where you've got to have loads back into Canada because of the cabotage rules, you could see rates go up, Dan, which is kind of counterintuitive. Yes. Even though cross-border volumes are going to fall, if carriers are looking for alternatives to their cross-border work intra-Canada, that could flood capacity on the intra-Canada piece and drive rates down. You might see the opposite on the cross-border piece. So
100%.
this is.
Well, I mean, think about it. If a carrier loses 30% of their cross-border freight, they got to try and fill their trucks with something.
Yeah.
Or downsize their fleet or something, right? But
yeah, it's not like you can just run the other 47 states in the US. Here you've got a handful of provinces and a lot of space in between.
Yes.
So, it's a very particular freight task you've got in Canada. So I don't see a lot of upside for carriers. But again, Dan, hey, we were predicting this months ago, right? This is what we saw coming, was that we wouldn't know until the second half of this year what freight demand was going to look like. And of course, it's created all the uncertainty that we thought it would. And I think a lot of people are going to hit the pause button. I'm happy. I would be really happy with the status quo. My biggest concern is we see demand destruction and the wheels literally fall off. And we see demand drop because manufacturers just say, you know what, cost of capital's high, interest rates aren't coming down. We're going to pause our investment on that new factory or that new production line. And we get into a period where it's another 2024 where it was kind of blah. Ken said it was kind of meh, like it just 2023 and 2024 were very flat years from a freight perspective because we were still coming out of the recession. I think the last thing we need is another year like that, for carriers. So, brokers in particular, their margins are going to be, they'll struggle to make margins in a market like this where rates aren't going to materially lift. Carriers are kind of at rock bottom. There's going to be an inflection point where the marginal carriers will have exited, exited as past tense.
Yeah.
It's kind of bizarre that it's still happening, right? We're still seeing carriers leave the market. We haven't. People, in the earnings calls that were out last week, big carriers were talking about, the common theme was things are getting better. We're seeing a little bit of increase in rates, on the contract side. Looks like there's some tailwinds, but there's still excess capacity.
Yeah.
Market. So that's what we're dealing with here. And I don't see anything changing until we get into the second half of this year. And even then, I was listening to a couple of guys that were kind of know a lot about macroeconomics, and they were talking about a freight recovery or a general recovery in 2026. Now, this was in late 2024. And I thought, oh, you're going to skip 2025 completely, and we're not going to see a recovery until 2026. So Paul Bingham from JOC, or Standard & Poor's Global Intelligence, was on our show, and that's what they were talking about. They had readjusted their GDP expectations down for 2025 and talking about a recovery in the economy in 2026. Dan, that's a long way away for a lot of people who are struggling right now.
Yeah, 100%.
Yeah,
100%. And I mean, it'll be interesting how it all unfolds. It'd be interesting to continue this conversation with you, because you look at different markets, right? And I had somebody say to me the other day, oh no, things are turning around, it's tough to find trucks. I said, well, it was tough to find trucks. I said, because we had a polar vortex situation happen down south. So I said, absolutely. I mean, we had freak snowstorms
Yeah.
everywhere. I
Yeah.
mean, Highway 11 in Ontario got closed, and
Yeah.
like we've got storms that
Right.
cripple
Yeah.
snowbelt towns like Muskoka and that kind of stuff. I said,
Yeah.
so yeah, that's the reasoning why. Like, it's not that we've had this mass exodus of trucks. It's going to turn around once the weather acclimates and just
It's
kind of
just seasonality, Dan. This
yeah.
happened last year. Remember on the show at the start of the year, like we saw rates go up at the start of January. The reason last year rates went up at the end of January because the polar vortex came in later than this year. So what's happened is the market is seasonality. It always gets cold. This isn't a surprise. Rates tighten, capacity, gets a little bit tighter. Reefer capacity tightens because we're moving dry freight into reefers. That happens every single year. That shouldn't be a surprise. What's interesting, though, Dan, is rates dropped pretty aggressively from about mid-January to now. Like, they're down almost 20 cents a mile in a fairly short period of time. And our rate cast has them already bottomed out. So normally they slide until the end of March. Like when you look at sort of the year-over-year trend lines of where rates go, it looks like they've already bottomed out at the start of February and will flatline now until we get into spring and produce season. So it'd be interesting to see if that forecast plays out. But it looks like the big rate reduction we normally see in Q1 may have already occurred, which would be great news for carriers. I'm not so sure, though, with where we stand with all the uncertainty around tariffs.